Welcome to FXTech's comprehensive analysis of the NZD JPY currency pair for the period of October 13th to 18th, 2025. In this presentation, we'll examine the current market conditions, technical indicators, fundamental factors, and provide actionable trading strategies. The New Zealand dollar against the Japanese yen has shown significant volatility during this period, influenced by both domestic economic developments and global market dynamics. We'll break down the key levels, important news events, and give you a clear roadmap for navigating this currency pair in the short to mid-term. Let's dive into the analysis. NZD JPY is currently trading at 86.749 Japanese yen, showing a modest daily gain of 0.20%. The pair opened at 86.517 and has traded within a range of 86.329 to 86.807 today. What's particularly interesting is the divergence across different time frames. Short-term momentum from 30 minutes to 5 hours shows strong buy signals, suggesting immediate upward pressure. However, the daily trend remains neutral, indicating consolidation. Most concerning for bulls is the weekly time frame, which flashes a strong sell signal, pointing to a longer-term bearish trend. This mixed picture suggests we're seeing a short-term correction within a larger downtrend. The 52-week range spans from 79.81 to 92.50, and we're currently positioned in the middle of this range. Looking at performance across various timeframes reveals the underlying weakness in NZD JPY. Over the past week, the pair has gained a modest 0.32%. However, zooming out tells a different story. The one-month performance shows a decline of 0.35%, while the year-to-date figure stands at negative 1.35%. The one-year performance is particularly concerning, down 4.46%. Interestingly, the 6-month view shows a gain of 1.76%, and the 5-year perspective reveals a substantial 24.93% increase. This data pattern suggests that while the long-term trajectory has been positive, recent momentum has turned decidedly bearish, with monthly and yearly declines despite short-term gains. Let's break down these performance figures in detail. The one-week gain of 0.32% represents the most recent short-term strength. The one-month decline of 0.35% marks the beginning of the bearish turn. 6 months ago, NZD JPY was 1.76% lower, showing some medium-term resilience. However, year-to-date, we're down 1.35%, and the one-year performance of negative 4.46% confirms the bearish trend. The 5-year gain of 24.93% provides historical context, showing that despite recent weakness, the pair has delivered substantial returns over the longer term. The overall trend analysis clearly shows recent weakness with monthly and yearly declines, despite those short-term gains we mentioned earlier. Technical analysis reveals critical levels that will determine NZD JPY's near-term direction. The key resistance zone sits between 86.86 and 87.00, representing a crucial breakout level. The current price of 86.749 is approaching this resistance, making the next few sessions critical. On the downside, we have multiple support levels. First support comes in at 86.40, followed by secondary support at 86.00. The major support level is at 85.35, where a double bottom pattern has formed. This double bottom is particularly significant as it represents a technical formation, where the price has tested this level twice and bounced, suggesting strong buying interest. As long as this support holds, there's potential for consolidation, but a break below could accelerate the downtrend. The New Zealand dollar faces significant headwinds from domestic factors. First, the Reserve Bank of New Zealand delivered a surprisingly deep rate cut of 50 basis points, bringing the official cash rate down to 2.5%. This dovish move signals concerns about economic growth and puts downward pressure on the currency. Second, New Zealand's trade deficit has widened dramatically to negative 14 billion New Zealand dollars, despite export growth of 19%. This means imports are outpacing exports significantly, a bearish signal for the currency. Third, GDP data shows strong contraction in recent quarters, with the economy displaying negative growth. These three domestic factors combine to create a challenging environment for the Kiwi dollar. Beyond domestic issues, external factors are amplifying pressure on the New Zealand dollar. New Zealand's economy is highly exposed to China, and Chinese GDP growth has slowed to just 4.8% in Q3, with a deepening property sector slump. Since China is New Zealand's largest trading partner, this slowdown directly impacts Kiwi exports and economic prospects. Additionally, escalating US-China trade tensions are creating risk-off sentiment in global markets. Trump's threat of 100% tariffs on Chinese imports is particularly concerning, as it would reduce Chinese demand and indirectly hurt New Zealand exports. These external headwinds, combined with dovish monetary policy and weak economic fundamentals, create a strongly bearish environment for the New Zealand dollar. While the New Zealand dollar faces headwinds, the Japanese yen is finding support from several factors. Political stability has returned to Japan with the election of Sanai Takaichi as the new prime minister, bringing confidence and clarity to markets. She's Japan's first female PM, signaling progressive change. The Bank of Japan maintains its dovish stance, with the policy rate at 0.5%, and no immediate rate hike expected, providing stability and predictability for the currency. Importantly, the yen is benefiting from safe haven flows as global uncertainty and US-China trade tensions drive investors towards safer assets. Finally, the Nikkei 225 stock index is hitting record highs, reflecting strong domestic economic confidence. This combination creates a supportive environment for the yen, particularly against commodity currencies like the New Zealand dollar. Several major events have shaped NZD JPY's movement during our analysis period. On October 8th, the RBNZ cut rates by 50 basis points to 2.5%, a surprisingly aggressive move that weighed heavily on the Kiwi. October 9th saw strong action in yen crosses with commodity currencies, indicating heightened volatility. Between October 13th and 14th, US-China trade war escalation intensified, with Trump threatening 100% tariffs on Chinese imports starting November 1st, impacting New Zealand export prospects. On October 20th, China's GDP data showed growth slowing to 4.8% in Q3, negative for NZ exports. Finally, on October 21st, New Zealand's trade deficit widened to negative 14 billion New Zealand dollars, despite 19% export growth. Also on the 21st, Takaichi's election as Japan's PM brought political clarity, stabilizing the yen and boosting the Nikkei to records. For the short-term outlook of 1 to 2 weeks, NZD JPY is expected to trade within a range of 85.35 to 87.00. The key resistance zone sits at 86.86 to 87.00, a critical level that must be broken for any bullish continuation. With the current price at 86.749, we're approaching this resistance. First support comes at 86.40, followed by the major support at 85.35, where the double bottom formed. Our trading bias is bearish, below 86.86. The recommended strategy is to sell on rallies around 86.78 to 86.80, with a stop loss at 87.50 to protect against a breakout. Take profit targets are set at 85.32 and 85.00, offering a favorable risk-reward ratio of approximately 1 to 2. Confirmation of the bearish move would come with a break below 86.40. Looking at the midterm outlook for 1 to 3 months, we expect the bearish trend to continue. The projected trading range is 83.00 to 89.20, with weakness likely as long as the pair remains below 89.20. The weekly time frame shows a strong sell signal, confirming the bearish bias. 4 key drivers support this outlook: the dovish RBNZ policy with the OCR at 2.5%, New Zealand's widening trade deficit of negative 14 billion New Zealand dollar, China's economic slowdown with GDP at 4.8%, and escalating US-China trade tensions. These fundamental factors suggest the path of least resistance is to the downside, with potential to break below the 85.00 level and target lower levels in the coming months. Traders should position for continued weakness in NZD JPY. Our recommended trading approach centers on a bearish bias for NZD JPY. The core setup involves entering short positions in the zone between 86.78 and 86.80, which represents selling on rallies near resistance. Take profit targets are set at 85.32 for the first target and 85.00 for the second target. Risk management is crucial. Place your stop loss at 87.50 to limit potential losses. This setup offers approximately 70 pips of risk against 145 pips of potential reward, giving us a favorable risk-reward ratio of 1 to 2.1. The strategy type is sell on rally with a time frame of 1 to 2 weeks. Let's detail the key parameters of this trading strategy. The risk-reward ratio of 1 to 2.1 means for every dollar risked, you stand to gain $2.10, which is favorable for consistent profitability. This is a sell-on-rally strategy, meaning we're waiting for the price to move up toward resistance before entering short positions. The time frame is 1 to 2 weeks, making this a short-term swing trade. For confirmation, watch for a break below 86.40, which would validate the bearish setup and confirm continuation to the downside. However, if the price breaks above 87.00, this signals a bullish reversal and invalidates our bearish setup, requiring you to exit any short positions. Always respect these confirmation and invalidation levels to protect your capital and maximize your edge in the market.